and welcome to Macros with Mythili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. In this edition, we're going to turn the spotlight on a sector that has the potential to make or mar our macroeconomic fundamentals, the oil sector. And in the interest of time, I'm not going to spend time explaining why. I think everybody knows. I will leave that moreover to our experts, all three of who have years of experience and in-depth knowledge of what a sector that defies easy understanding given the mix of geopolitics, economics, commerce and what have you. So let me welcome to the show Vivek Rai, former Petroleum Secretary, Government of India, Sanjay Baru, former editor, media advisor to the former Prime Minister Manmohan Singh, author and authority on geoeconomics, and of course Vandana Hari, the Singapore-based oil sector expert, founder, CEO, Vanda Insights. Let me start by asking all three of you to do some crystal gazing. What is the outlook for the global oil market and related to that global oil prices, both in the run-up to the 4th November when US sanctions kick in on Iran and post-November 4th? Let me start with you, Sanjay.
Well, I'm not a market expert, as you know, but I think we are in a very difficult situation right now. The experts whom I keep in touch with are quite concerned, not just because of Iran, but because of what's happening in Venezuela, what's happening in Saudi Arabia. There is a global geopolitical context today which has created lots of uncertainties for the oil market.
Would you agree with that assessment, Vivek? You were Petroleum Secretary during the period when oil prices had hit the roof. So do you see a return to those kind of levels close to $150 a barrel, or do you think those days will never return? We now have shale oil whose production can be ramped up quite quickly and that can come to the rescue. Would you agree with that, Vivek?
Well, you know, it'd be foolhardy for anybody to predict where oil prices are headed. But by and large, the sense seems to be that they are going to be in the range of $80 or maybe a maximum of $100, and the days of $150 a barrel are not likely to come. That's the sense I've got, and I've been meeting a few people recently, and they've all felt that the market is reasonably well physically balanced in terms of supply and demand, but emotionally disturbed. Now that is something which is, the markets are driven by emotion, so you can't discount that. But physically, it seems to be in balance, emotionally unbalanced, and therefore it's not headed for $150, but it might be headed for $90 or $95.
Well, it's very reassuring to hear, Vivek, that as per your expert opinion, oil will not cross that $100 mark. But at the recently concluded meet, Vandana, with oil majors in Delhi, the Saudi delegate described the market as well balanced, following OPEC's decision in June to increase supplies by 1 million barrels a day. But the Indian Petroleum Minister, Dharmendra Pradhan, said many smaller OPEC producers had not increased production. As an independent observer, what is your take? Has OPEC stuck to its commitment, Vandana?
So, Mythili, that observation is quite correct. There does seem to be enough supply in the market, global market now being the operative word here. The OPEC and Russia, let's say just OPEC and Russia, because in the non-OPEC camp, aside from Russia, nobody really has spare capacity. But a handful of members within OPEC, Saudi Arabia, Iraq, Arab countries in the neighborhood, have indeed increased production. So what we have seen actually and been obvious from the latest monthly reports by the International Energy Agency as well as OPEC is that inventories in the OECD countries have actually been rising both in July and August and most possibly in September as well. That is a very clear sign that there is enough supply in the market. The big question and the worry in the market right now is, yes, there is enough supply today, but what is the likely situation after November once the U.S. sanctions against Iran take effect? Now, clearly, Iranian supplies exports have been dropping in anticipation of that, but most of the market participants anticipate that the real crunch time will come after November 5th. So that's the real fear in the market right now, not so much about supply today, but the supply starting from next month.
Sanjay, just recently we saw none less than the Prime Minister appeal to oil majors to keep India's circumstances in mind and allow us to make rupee payments for our oil imports, bulk of which is currently paid in dollars. Given that we're talking primarily about Iran, which is now our third largest supplier, do you think it will be possible? Will the US be willing to look the other way? And given the fact that they see India now as a strategic partner to contain China, will they look at us a little more kindly? Or in the days of Trump, can we not expect any such kindness? Sanjay?
Well, I mean, in the days of Trump, nothing is predictable. But I do think that, as far as oil is concerned, it's a strategic importance to us. I don't think we can allow any country to dictate to us where we buy oil from and how we pay for it. And my own view is, given the developments in the Gulf region, what is happening with Saudi Arabia, even the United States may not continue to be as tough on Iran as it has been in the last few months.
Well, that's reassuring to hear, particularly given how, as you said, oil is so critical for our survival almost. Vivek, in January 2014, you had spoken about how India had been perilously close to the brink of, approaching the IMF thanks to rising oil prices and the consequent havoc on our external sector and the rupee. Does the present situation compare with those times? Are we better off, worse off? Everybody says we're better off. Would you agree with that assessment, Vivek?
Yeah, absolutely. I think there's no question of approaching any multilateral institution for any financial assistance. In fact, in 2014, when I made that remark, it was more in the historical context of 1981 and 1991, because when we got hit by the oil crisis in 81 and again in 91, that's when we had to get to the IMF for a bailout. But those conditions don't prevail today. So I don't see that as a possibility or a prospect in the near future.
Oh yes. Vivek, in fact, for the second time in a row, you've been much more reassuring. Because unlike Vandana, who says that one can't be really sure of what the future holds, because Vandana, in fact, that is true, that unlike the past occasion when oil prices rose almost linearly, this time what we're seeing is prices yo-yo rather than increase steadily. So can we take hope from the fact that the underlying long-term trajectory is not necessarily linear and upwards? In fact, the Saudis hold that by 2019, the demand-supply balance will shift in favor of oversupply. So is it only a question of tiding over the intervening months, Vandana, because 2019 is not so far off?
Mythili, if you're looking from the perspective of an import-dependent country like India, a country that has fast-growing energy needs, unfortunately, I have to say, hope is not a word I would use. Why I'm saying that is, my personal feeling is that whether you talk about the short term, next 12 to 18 months, or you talk about medium term, next 5 to 10 years, the oil market is more certainly set for very high volatility. And the reason I say that is, as you've seen just in the past few months, geopolitics has become a major factor. So what happens to Iran sanctions? And again, the Iran sanctions issue is not something I expect to go away anytime soon. They're really head-butting, as we can clearly see, the Donald Trump administration in the U.S. and the Iranian administration as well. And if you look a little beyond that, of course, we come to demand, which remains a big uncertainty in the current environment. But if you look a little beyond that, let's not forget that starting from 2015, there has been successively a huge cutback in upstream investments by all the oil companies, whether you're talking about oil majors, national oil companies, mid-sized independents, everybody has cut back. And though, yes, we do talk about 2030, 2040, global oil demand is likely to start plateauing, but that doesn't mean oil demand is going to go away. So we are going to have continuing substantial oil demand globally, but not enough production. The decrease in upstream investment of the past several years is going to come back to bite. So basically what we're going to likely see is continuing boom and bust cycles in the oil market.
Sanjay, speaking to the oil majors again at the same meet, the Prime Minister Modi also lamented, and if I may use that word, that the global oil market is driven almost entirely by producers and consumers have almost no clout. He hinted that sustained high prices could well end up killing the goose that lays the golden egg. Given that India and China are two huge consumers of oil, why is it that the oil market is so one-sided? Surely if India and China join together, and we could join together on specific issues, would not things be very different, Sanjay?
It would, of course, be. But, we've been talking about India and China coming together and trying to, dictate terms or set terms as consumers for some time now. I mean, I organized a conference at the International Institute for Strategic Studies in Bahrain in 2011, by when already India and China were the dominant markets for the Gulf. As you know, now more than half of Gulf supply goes eastward towards Japan, China and India. It's not just India and China, but Japan, South Korea. So the East Asian and the Asian countries can come together and demand new terms of trade. But that has not happened, it has not happened for a variety of reasons. But I do think that the cartel of producers, which now includes the United States, is a far more powerful one than any alliance of consumers.
And you don't see that changing in the near term, Sanjay, India and China coming together?
Not in the near term. It could change in the future. I mean, I don't rule that out. But, as I said, on so many issues, if India and China come together, we can deal with a lot of global problems. We've seen that, at the time of the climate change conference. But what happened after that? We saw that in the WTO. But where is the WTO today? When the international cooperation of India and China has been weak for a variety of reasons. And so I don't see in the oil sector that happening suddenly overnight.
Vivek, now let me turn to the domestic scenario. How should we deal with rising oil prices? Can we treat the higher oil prices as a pass-through and allow domestic prices to rise? Or is that an impractical idea that can only come from textbook economists and is not an option in a poor democracy, particularly with elections looming ahead? What would you have advised the government if you were still Petroleum Secretary, Vivek?
I think there's no option but to pass through, because if you're consuming so much and you're dependent on imports, there's no way that you can absorb the price differential in your budget. And if you look at what happened between 2008 and 2013-14, I think we absorbed something like $100 billion of money into oil subsidies. And that kind of money would have gone into exploration or production or buying assets abroad. Would have been a much better, more longer term utilization of that money. So as a matter of policy, I don't think we should be able to absorb any of these price increases. We have to pass them through in whatever manner we think we can.
But Vivek, remember, every government, its main aim is to get re-elected. So given the fact that higher oil prices invariably hit inflation, and inflation is a very powerful factor in election winning or losing, do you think the government can really afford to kind of continue to allow it to pass through if prices continue to rise?
Well, as of now, the government is showing strong political will to let market forces play out in the Indian economy. And I think that is a credit to the government. And I think we overrate and overstate the impact of the pass-through on the pockets of the motor vehicle drivers, the bus drivers and the scooter drivers. They have to absorb a little bit because we have no other option. Our import dependency has gone up from 77% to 82% in the last 4 or 5 years. And it's projected to hit 90% by 2040. So, how can we just carry on like this? We have to find ways of either passing through or find alternative sources of energy. There's no other option. If your import dependency is going to go to 90% by 2040, you are completely at the mercy of the producers.
Very true, but it's just that every government's resolve weakens as elections approach, and we've already seen the government backtrack just a little bit as far as reform in the oil sector is concerned. But Vandana, recently the petroleum minister, he talked about how the oil market is determined more by sentiment rather than by macroeconomic or market fundamentals. And we saw Vivek repeat the same thing, saying it's an emotional market. But isn't that true only of the very short term? And long term, shouldn't market fundamentals, market forces of demand and supply have a bigger bearing on prices rather than sentiment, Vandana?
So my personal belief is that in an oil market, and certainly in the current situation and the foreseeable future, fundamentals and sentiment are both equally important. And why is that? I think we should not think poorly of sentiment. It provides very important cues to the market on whether to change policies with regards to demand and utilization of fuels, or what to do with regards to supply. So as far as I can see, sentiment as well as fundamentals are both going to remain in play. The problem is that while sentiment tends to be quite volatile and induct more volatility into oil prices, what we have seen from the past few years is that the fundamentals, supply and demand, have also become quite uncertain and unpredictable. So basically, I have to see volatility from all sides.
Well, I'm afraid it's time for us to slip into a very short break. Please stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and I'm in discussion with three experts, Vandana, Hari, Vivek Rai and Sanjay Baru, on what does the evolving oil dynamics, the global oil dynamics mean for India, and how do we address the problem of our huge import dependence on the matter of oil. Sanjay, let me ask you the same question that I'd asked Vivek earlier. How should we deal with rising oil prices? And would the answer be different if elections were, say, 3 years ahead rather than just less than a year ahead, Sanjay? Because you've been in touch with under the UPA government, you've experienced it, you've seen it all, how politics plays such a huge role in determining whatever you do as far as oil prices are concerned. Sanjay?
Yes, I think, first of all, I think there's a fundamental difference between the UPA government and the present government. UPA was internally divided. Don't forget that at one point Manmohan Singh had to remove Manishankar Iyer and bring in Murali Devra. The cabinet was internally divided on how to deal with rising oil prices. And unlike the present government, I think Mr. Vivek Rai was right when he said that this government has the capacity to take decisions. But having said that, I keep getting reminded of how we dealt with food shortage in the 60s. Don't forget Lal Bahadur Shastri, not a very strong prime minister, a weak prime minister, went to the country on radio and asked people of India to sacrifice, said don't have 2 meals a day, have 1 meal a day, or at least have 2-3 evenings of no dinner, cut down on food consumption, because we were importing food at that time. And we didn't have enough foreign exchange reserves. There was a food crisis. So similarly, if today the Prime Minister were to go on television and explain to the people of India why he is in a difficult situation as far as oil prices are concerned, I think it is still possible for the government to manage going into elections with what one would regard as high oil prices. It's all about political management, how you approach a difficult issue. And so far, the government has given the impression that the problem is international. The problem is with the states not willing to cut duties. That if only we can cut duties, we could have solved this problem of high prices. No, I think the way to do it is to explain what the problem is in the market and explain why the government is unable to reduce prices. And I don't see consumers revolting.
Okay. Sanjay, you're speaking like an idealist, and I'm not sure the world today is the same as it was in the 60s, when I think people, societies, etc. did have a little bit more civic consciousness, caring in them. Today's world is much more selfish, but I think yes, it's worth a try, all right. In fact, Vivek, given our overwhelming dependence on oil imports, as Sanjay and everybody has agreed, is it not time that we thought of a longer-term strategy really to reduce our dependence on oil imports, rather than subject the economy to periodic convulsions like this? There has been talk of adding to our strategic reserves, etc., but that cannot be a long-term answer. It will only buy us time. So what would you advise as a long-term strategy? And why haven't governments taken more action on this? We've talked of renewables, etc., but will that be enough? I'm sure when you were in government also, you must have been seized with the problem. What are the kind of suggestions you made, Vivek?
Well, the first thing that you need to do is to energize your exploration within the country. We have about 3 million square kilometers of sedimentary basins, and we've really not been able to explore them well. About 25% have been explored well. So I think the first strategy is to really expedite and energize the exploration of the sedimentary basins, both onshore and offshore. And for that, the government in the last 4 years has taken several steps, but they still have some way to go because the investments that are required are not coming in. And what further steps need to be taken is a matter that needs to be discussed in great detail with the investors and then decide what to do. So I think the first thing really is exploration.
Vanda, we've also been hearing a lot of talk about how renewables are going to reduce, if not completely replace oil demand for some time in the future, But is that more wishful thinking than anything else?
Renewables, electric vehicles, and let's not forget a lot of efforts also and progress also happening on the front of energy efficiency, energy conservation. So all of those are progressing pretty well, progressing hand in hand. The problem is that as far as renewables are concerned, it's, the wind doesn't always blow, the sun doesn't always shine. The intermittency is still a big problem. How that is to be solved, is battery storage technology is developing, but again, not advanced enough. So renewables are growing very fast. That is a positive. On the flip side of that, they're growing from a very, very small base. So when you compare the global population, the growth in urbanization, the growth in the energy use of the world, and you compare that with renewables growing from a very small base, it's quite clear that you can't pin your hopes on renewables coming to the rescue. Similarly, when you talk about electric vehicles, a very pertinent question a lot of people are asking, and not just because they're in the oil industry or they're stakeholders in oil, but it is a real question, that if the majority of electricity today and in the near future is going to be produced by coal, how are electric vehicles more environment friendly, right? So I think we're going to be grappling with those questions for a while.
Vivek, you wanted to add something about renewables, right? In the area
you need to obviously encourage renewables. You need to encourage biofuels, and all these things are happening. But what's happening is that if you see the structural composition of the energy basket, it doesn't get away from fossil fuels in the foreseeable future. The share of fossil fuels in the energy basket actually remains steady and increases. So renewables may go from 1% to 5% or 10%, but they're not going to go from 1% to 50%. That's not going to happen. And therefore, you really are stuck with oil and gas, and you have to focus on finding the oil and gas in India, or finding ways of financing it and importing it from abroad. There's no other option to that, at least till 2040, 2050. And that's the time horizon within which I think we can talk sensibly. The problem is that our exploration regime has been liberalized and has been revamped quite a bit in the last 4 years. But there are still certain things that need to be done. For instance, the gas that we produce domestically from our earlier contracts is being sold at a very highly artificially repressed price. Now, if you penalize production and you incentivize consumption, how are you going to produce more oil and gas? So I think there is need to further liberalize the gas pricing in this country. There is need to make sure that the gas producers get the money that they should be deserving, and that money should then be deployed in exploration activity. We don't explore enough. You might be interested to know that in the offshore, our exploration intensity is one well for 140 square kilometers of area, while in the United States it's one well for 14 square kilometers of area. So it's 10 times more intense than it is in India. And this costs a lot of money. And unless you have the money, unless your oil companies have the money, they can't explore. If you don't give them the money by artificially repressing domestic gas prices, how will they explore?
Absolutely. Tough choices everywhere. But Sanjay, what is your quick take on the appropriate strategy, both short term and long term for India? Sanjay?
Well, I entirely agree with Mr. Rai, whatever he has just said. There is no short-term escape from our dependence on oil. In the long term, apart from renewables, we have the nuclear option. We are not yet developing it at the pace at which we should be developing. But I do think that much more consumer consciousness has to be developed about our import dependence. We pretend that consumer is king in the energy market. That cannot continue. Consumer cannot ignore the fact of import dependence. So pricing, at the end of the day, I mean, you are an economist, I am an economist. At the end of the day, price is the only instrument in the government's hand. No other instrument works.
Very true, Sanjay. But in a democracy, I'm not sure how much leeway the government has when it comes to using price levers. Also, as far as the nuclear option is concerned, most countries in the world are now eschewing the nuclear option, but you still are a votary of it. Is it, Sanjay?
Absolutely. This is a mistake we make. We cannot go with the fashion of the day. India cannot avoid nuclear energy. India has to have a realistic pricing for imported oil. These are all tough choices, and one hoped that a majority government would have taken more tough decisions. But as has been said, in the last few months, the government has stood its ground, which is good. But going ahead, I think, given the fact that elections are coming, the only way in which the government can stand its ground is by appealing to nationalist sentiment. There is no other way.
Yes, indeed. As far as oil is concerned, India always has tough choices given our import dependence and given the fact that energy intensity will only increase. So tough choices, difficult days ahead, but I'm afraid we have no more time to discuss this very tricky issue. Thank you very much, Sanjay, Vivek and Vandana, for joining me in the discussion. Thank you also for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.